This is where it starts to get fun. So today we're going to talk about Milestone 6 on the Next Dollar Roadmap. That's saving for flexibility. By now you've done a lot of the hard work. You've paid off debts, you've built up an emergency fund, you've begun saving for retirement in tax-advantaged accounts. And Milestone 6 is really where you can start to exhale a bit. You get a lot more flexibility in your life. You can actually start to use some of that extra money to do things you kind of want to do, to have fun with. And to be totally honest, I'll say this again in other videos, but Milestone 6, 7, 8 can kind of be mixed. Milestone 6 is investor flexibility. Milestone 7 is saving for kids' college expenses or educational expenses. Milestone 8 is pay off any remaining debt. It's going to be mostly things like mortgages or student loans that are low interest in nature. You can really mix these based on your preference. I have listed them in order that I think is most optimal, but again, at this point, you've done the heavy lifting. From here on out, it's a lot easier, so it's not going to be traumatic to your financial situation if you take 6, 7, and 8 and kind of flip-flop them in any order at all. But now that you've done all the heavy work, you've got all those debts paid off, you've got your emergency fund, you're saving for your retirement pretty aggressively at a 15 to 25% rate based on your income, there's a new challenge to address. You need to figure out what you're going to do with your extra money now. Now, deciding what to do with your excess cash is very situational and goal dependent. You may want to push your retirement forward. You may want to set some cash aside for your kids' education, which is what we're going to talk about in Milestone 7, which is next. Do you want to start a business or an encore career and leave the work that you're doing now? Are there places you've always wanted to travel to but never had the money to do so in the past? Is there a renovation you want to do in your house, or do you want to buy a really cool car or something you've always had your eye on since you were younger? Maybe you've dreamed of owning a vacation home in a certain place or starting a real estate investment. Milestone 6 is where you can really start to dream a lot more and begin to really enjoy the benefits of all the self-discipline and all the hard work you've done from our starting point of the budget through milestone number 5. And since your dreams can vary significantly, flexibility should also be a trademark at this stage in your financial journey. Now, there's several points I want you to consider as you evaluate how you want to begin using your excess cash while keeping this flexibility in mind. The first thing is you don't want to take your foot off the gas. You want to keep saving money in tax-advantaged retirement accounts. Now, in milestone number 5, we talked about saving 15 to 25% of your income in tax-advantaged accounts. That's like your employer-sponsored retirement plans like 401ks, 403bs, 457s, TSPs. You can use IRAs. Whatever it is, basically leveraging the tax advantages those types of accounts provide, and saving 15 to 25% of your income to ensure that you have enough saved to actually provide for your way of life when you reach retirement age. Now, if you have money available beyond this 15 to 25% range, and there's still room in those tax advantaged account options, then those accounts really are still the most efficient way for you to save and invest. And if you don't have any immediate or near-term needs for the money, then by all means, you should continue to contribute to those accounts. Now, of course, the major drawback of putting money in tax-advantaged retirement accounts is that they typically come with restrictions on when you can make withdrawals without penalty. Normally, that's age 59 and a half. If you're comfortable waiting until age 59 and a half to fund your financial goals, then this isn't a problem. So maybe you want to buy a lake house, but you're good with waiting until you're 60, or you want to travel to Rome, but you're okay with waiting until 60. If that's the case, then you don't have to worry about it. Just keep saving in those tax-advantaged accounts until you cap them out. On the other hand, if you have those dreams or goals that are going to require significant financial commitment and you want to do so before you turn age 60, then there are other options you should consider. The first one I'll talk about is standard savings and checking accounts. They provide the flexibility that I talked about that is so important in this stage of life. And they do so in what is typically an FDIC insured account. Now, even if you don't stack up loads of cash in these accounts, odds are you'll at least want checking accounts to stage money for immediate and short-term needs anyway. And the primary challenge of standard checking and savings accounts, of course, is they're not likely to provide very impressive interest or returns on the amounts and balances that you have in the accounts. In fact, if you allow the balances in your checking and savings accounts to grow to significant sums, then you could be missing out on a great opportunity to generate more cash by seeking higher returns elsewhere. Now, in light of this, I would recommend opening a taxable brokerage account to give you both the flexibility and security you're hunting in this financial stage, along with the opportunity to invest and increase your net worth even more. Now, taxable brokerage accounts give you a wide range of investment options from cash to bonds and equities, but they also provide the convenience of easily transferring money in and out of the account as needed. Now, you can open a taxable brokerage account with hundreds of companies, but I would choose an option that offers a wide variety of diversified mutual funds or ETFs with reasonably low expense ratios and trading fees. You're thinking the Vanguards, the Fidelities, the Schwabs of the world. These are a lot of great options. Look into whichever one works for you. I'd also consider how user-friendly their website is, how comfortable you are using them, because it's going to be important that that brokerage account is something that you can access and feel comfortable using as you move money in, around, and through the account. Now, as far as what actual investments to hold, I'm going to get into that in a lot more detail later. Now, the next question to ask yourself is, can you skip ahead? And as you look down the next dollar roadmap at milestone 7, 8, 9, you may look at 7, the kids' education savings, or 8, the paying off remaining debt. And you might be asking yourself, can I move that in front of milestone 6? And the answer is yes. I've already said that's not really a big deal at this point. I did arrange the milestones in the order that I think is most optimal for general overall financial wellness. From here on out, the order really isn't as significant as it was for milestones 1 through 5. I'd liken rearranging milestones 6, 7, and 8 to like eating dessert before dinner. You know there are reasons you shouldn't do it, but at this point in your life, you've illustrated enough maturity that you can trust yourself to do things the way you want. You've made it to milestone 6, you've funded your retirement, you have emergency savings, you're debt-free. At this point, I wouldn't say you've won the game, but it should be pretty smooth sailing from here on out. You can adjust the order of the next dollar roadmap at this point from milestone 6, 7, 8, however you want, whatever way that suits you. The only word of caution I would give is to be sure you think carefully about what is most important to you and do that next. Take time to think about it and talk it over with the people in your life who know you well, and they can challenge you to think about things critically. Just because you have excess cash now doesn't mean you won't have any regrets about how you use it. And don't forget, you can do more than one thing at a time. You can operate milestone 6 and 7 and 8, or 6 and 8 without 7, or 7 and 6 without 8. The only limit is the amount of cash that you have available. Another question people often ask at this stage is, can I take on debt to fund these dreams or these plans that I have? And I don't love the idea of taking on additional debt at this stage in your life, but I don't think I would ever say never. I mean, you've done a lot of work already to get toxic debt out of your financial life. You know, why burden yourself with more? But here are some questions if you really think it's an option, or you really feel like it's necessary to fund the dream that you've got. Ask yourself some of these questions. Is the debt for an appreciating asset? Remember, that was a big qualifier as we sort of categorized debt back when we talked about toxic debt. Is it a secured debt? Is there an asset that it's against? Or is it unsecured debt that's going to have a higher interest rate? Is the payment on the debt combined with all of the other debt payments you have below 30% of your monthly income, or less than 3% of the amount of your net worth outside of retirement savings, like your cash and your brokerage and your primary home? In other words, do you have enough liquidity to easily service the debt? That's the question you're really trying to get to there. And finally, is the interest rate on the debt within 3% of the current 10-year Treasury note? Now, 10-year Treasuries are a great benchmark for defining a risk-free rate of return. If the interest rate on a loan you're taking out is far above that amount, then you probably shouldn't do it. So in summary, sure, there are ways to reasonably take on debt at this stage in your life, and I can understand not wanting until you're 75 years old to cash flow all of your dreams, but it takes a lot of work to get to milestone 6, and I don't want you to risk a sudden lack of focus and fall all the way back to having to pay off toxic debt again. So be careful. And the last question is, if you want to invest your excess cash or your excess income outside of a retirement plan to get that flexibility, where should you put it? I already talked about taxable brokerage accounts, but within a taxable brokerage account, there's not quite an infinite number, but nearly an infinite number of investments that you can make. And even though I hate to answer a question this way, the truth is it depends. And mostly it depends on when you plan to use the money. If you have plans for the money that are less than 5 to 7 years away, you should use fixed income securities like bonds or cash equivalents, or money markets, CDs, something like that, to earn some interest while preserving the principal. And if you do use bonds, by the way, make sure they are high quality bonds. Don't get junk, don't get risky stuff that's going to lose value or erode quickly over time. 5 years just isn't enough time to recover from a significant market dip, so stocks are not an option for such a timeline. And if your goal is 7 years or more down the road, then stocks like mutual funds, ETFs, not necessarily individual stocks, they're certainly an option worth considering. And we'll get to those in a second. But let's walk through several of the investment options that you have available in a brokerage account to highlight when and where they might be appropriate to own. Now, first, let's talk about Treasuries. Treasuries is a pretty broad term. It could mean T-bills, T-notes, or Treasury bonds, I-bonds, TIPS. There's actually several other Treasury instruments that you could purchase from Treasury.gov. But ultimately, Treasuries are debt securities issued by the United States Treasury. You give them cash and they promise some sort of return, some defined period down the road. Now, typically yields from Treasuries are not going to appear all that impressive because their risk profile is about as low as you can get. The government can literally print more money to pay their debt. You see, Treasuries are actually auctioned off to bidders all over the country. Banks, individuals, financial institutions, they're all bidding competitively to buy the available Treasuries that are in the market, which the the Fed changes based on how much cash they want in or out of circulation. And because the risk on these instruments, these debt instruments, is so low, the Federal Reserve doesn't have to provide exciting yields in order to attract investors to these Treasury instruments. The people buying them are actually looking for a low-risk, mediocre reward. They're okay with the lower returns as long as their money, their principal, doesn't disappear. Now, TIPS and I-bonds are good for protecting your principal from inflation, but for little else, to be quite honest. Treasury bills, notes, and bonds all provide a guaranteed rate of return depending on when you buy them. That's the bid price or the bid rate that you actually buy them for. You're guaranteed that rate of return when they mature. T-bills are coupon-free bonds. That means there's not a coupon that you would, this is really old school, but submit for your bond payment. You just buy it one time, and when it matures, you get a single discounted price from their par value when it matures. So T-bills are available in maturities of 4, 8, 13, 17, 26, and 52 weeks, I believe. So a year or less. So you're going to get your money back, a certain defined period, and that rate is going to be basically prorated for the amount of the year on an annual rate. So like if your annual rate is 5% and you had a 26-week T-bill, you'll get basically half of 5% or 6 months worth of that interest for the amount that you loaned to the Fed. Now, similarly, Treasury notes and bonds can be bought with maturities at different times. I think T-notes are 2, 3, 5, 7, and 10 years, and then bonds are available in 20 or 30-year categories. Notes and bonds, they pay a yield to their owners every 6 months, and they're sold at par with a promised yield. So it's not quite the same as a T-bill where you pay a discounted rate. You actually buy the bond, and then you get that promised yield every 6 months that you own it. Now, I did say you can go to Treasury.gov and buy Treasuries yourself. That's something you can do anytime you want. Go over there today if you want to. Their website's kind of a pain to use. But the easiest way to own Treasuries is to buy them inside of an ETF or a mutual fund. Next up is corporate bonds. I'm not going to go deep into the weeds on bonds. I do have another video about bonds you can check out if you want to learn more about them. I'll link it above. But put succinctly, bonds are debt. A bond is almost always issued at a value of $1,000. That's the issue price. That's what you give to the bond issuer for the pleasure of holding their bond. Now, in return, the bond issuer will pay you some promised yield. That's called a coupon rate. And they do so every 6 months usually. That's a defined interval. It's part of buying the bond. Almost always it's 6 months. And they'll do that for some number of years until it reaches a maturity date that's defined when you buy the bond. Now, once the bond matures, you get your last interest payment, and you're given back the money you paid for the value of the bond, so $1,000 per bond, usually again, and the deal is done. Now, there are a couple of important things to remember about bonds. First off, not all bonds are created equal. Many have a relatively low risk of default, but there are many that are incredibly risky. Now, for some reason in the investing world, a lot of people have grown accustomed to referring to bonds as low risk and stocks as high risk, and this is simply not accurate. Now, while I can certainly see a valid argument for bonds being less volatile than stocks, volatility is only one component of risk. There are many other factors to consider. Now, second, it's much easier to buy bonds that are held within a mutual fund or an ETF than it is to go out and buy bonds on the market on your own. Next up are municipal bonds or munis. These are bonds that are issued by municipalities in order to raise funds for public projects like roads, bridges, schools, things like that. The key characteristic of munis is that their yields are not taxed at the federal level, and many times they're not taxed at the state or local level either. Now, if you have significant assets, like you have a lot of money, and you're looking for a way to generate regular tax-free income, munis are a very popular place to look. And again, you can buy munis directly, or you can purchase them within a mutual fund or an ETF. Next up are stocks. Stocks are a portion of ownership in a company. That's what they are. You own a small piece of a company. Companies issue stock as a way to raise capital. Once their shares are issued, they can be traded on exchanges between people or organizations on a stock market. Of course, individuals like you and I have to trade through a brokerage which trades in the exchange on our behalf. Now, the prices of stocks in markets go up and down based on what people are willing to pay for each share of stock at a given time. This is completely unpredictable. If there's any one point you should understand about stocks, it's that you can't predict their performance in the short term without information that other people don't already have. Do not try. And if you have information that other people don't have, then you can't trade based on that either, because you'll wind up in jail. So don't try that either. So now you may be asking, Curt, if stocks are so unpredictable, why should I own any of them? Great question. And the answer is because history has shown that portfolios which hold a broadly diversified basket of stocks for long periods of time outperform other investments with similar risk profiles. Put another way, if you buy a diverse bunch of stocks and leave them alone for a very long time, the returns are really hard to beat. And diverse is a key word that I use there because single stock ownership is incredibly volatile and risky. The easiest way to capture broad market diversification at low cost is to use mutual funds and ETFs. So let's talk about mutual funds. Legally speaking, mutual funds are a type of company. They buy up large amounts of stock, bonds, or other equities, and the value of the fund, which is also known as the net asset value, is based on the value of the underlying assets in the fund. And when you buy a share of a mutual fund, you're buying a stake in the fund corporation and thus the assets that it holds. In other words, you actually own a portion of the assets within the fund. That also means you own a share of any appreciation the assets experience, as well as any taxes or expenses that are owed in the process of operating the fund. Now, generally speaking, mutual funds will have some stated investment strategy designed to focus on a market segment, or an investment class, or an asset type, or a commodity, or a tax treatment, or a retirement date, or an index, and that attracts investors based on their own personal investment goals and strategies. These are stated in a fund prospectus. Now, the major draw of mutual funds is they provide broad diversification and they consolidate it into a single asset. This is very convenient for investors, especially retail investors like you and I. Now, as you look for mutual funds, there are several things to consider. First, does the fund strategy and prospectus align with my investment goals? If you're seeking growth because you have a long trajectory to retirement, then you probably shouldn't buy a very conservative bond mutual fund. On the other hand, if you want to preserve capital, then you shouldn't go out and buy, some triple Q, highly leveraged, margin trading, NASDAQ, high tech, growth fund. The goals of the mutual fund should match and align with your own personal goals. Second question, is there sufficient transparency regarding the assets that are held by the fund? Now, generally, the answer to this is going to be yes, because the Securities and Exchange Commission requires that mutual fund companies actually present this information to their investors, but you want to make sure it's not hard to find out. What do I actually own? That should be something that is readily available and that you can find easily. Third, are the expense ratios in line with funds that have similar focus or some other similar strategy? So if you're buying, say, an S&P 500 index fund, that should be a very low expense ratio, like less than 0.1%. On the other hand, if you're buying a mutual fund that invests in emerging markets overseas in third world countries or something like that, you should expect expense ratios that are much higher because it's much more challenging to operate a fund that is seeking and I guess following that kind of strategy. Now, similar to mutual funds or exchange traded funds or ETFs, they consolidate a broad group of securities or assets into one investment with similar strategies to mutual funds. A lot of mutual funds have sister ETFs that basically operate and focus the same way. But the key difference between ETFs and mutual funds is their structure. When you buy an ETF, you buy a tradable share of the ETF that holds the assets instead of actually owning a portion of the actual assets in the fund. So as a result of that structure, ETFs can be traded throughout the day in a stock exchange, where mutual funds are traded once daily according to the net asset value at the end of each trading period. That ability to be traded on an exchange means the price of an ETF can drift above or below the actual real value of the assets that are actually held in the fund. Now, to keep the price of the ETF closely aligned with the actual value of the assets it holds, each ETF has an authorized participant, or AP, that trades the fund itself or the assets held by the fund through a process known as creation and redemption. When an ETF is priced at a premium, meaning the ETF is trading above the value of the actual underlying securities inside of the fund, the authorized participant can buy shares of stock from the open market and sell them to the fund in exchange for shares of the ETF. This increase, or it's called a creation unit, of available shares in the ETF will cause the price to fall. Now, conversely, if the price of an ETF is trading at a discount, meaning the ETF is trading below the actual value of the securities within the fund, the AP can then buy shares of the ETF from the market and exchange those shares for stocks owned by the fund. This is known as redemption. Now, there are a few benefits ETFs provide. The first is you can trade them anytime the market is open, just like a regular stock. That's a lot of flexibility that mutual funds don't have. Second, and perhaps the thing I like most about ETFs, is they don't have to sell assets within the fund to pay shareholders who are exiting the fund. So their transaction costs tend to be much lower than a mutual fund. And third, which is kind of a spin-off of the second thing I talked about, ETFs are also typically more tax efficient, again, because they're traded much less than their mutual fund counterparts. All right, another investment option at this stage, Milestone 6, is real estate. And if you've ever considered owning real estate as investment, this is the time you can prudently consider it as a possibility because you now have enough cash available to cautiously step into being a landlord. The fact is, real estate can be a very rewarding and lucrative investment, and this is especially true if you utilize leverage to finance the purchase of property. Now, the best way to illustrate this is through a basic cash-on-cash evaluation. Cash-on-cash is the amount of cash returned from a given investment over the amount of cash you put into the investment. So suppose this guy named Larry Landlord buys a house for $100,000. He puts 20% down, so that's 20 grand, to purchase the house, and then he rents it to a tenant for $1,000 a month. And Larry pays $500 for the mortgage each month, and he pockets the rest. In this scenario, Larry's cash on cash is $6,000 divided by $20,000, or 30%. The $6,000 from 12 months of rent, which is his net profit, and the $20,000 is the total of cash he had to pay for the down payment on the mortgage in the first place. On the other hand, if Larry had paid for the entire value of the home in cash, his return would have been $12,000, which is double the $6,000. But he would have put $100,000 into it, so his cash on cash would only be 12%. That's still not a bad rate of return, but it's only 40% of the return of cash you'd have if you had used leverage instead. Now, this is a very basic and simple and probably unrealistic example. You probably actually won't be able to charge 1% of your investment value in rent each month unless you own the property for quite a while. Not to mention, I excluded a lot of other expenses that landlords face, like maintenance, taxes, but I do hope it provides a glimpse of what's possible in real estate. Now, I would also urge you to do your homework before jumping into real estate. It is not for the faint of heart, and it should not be considered a passive investment. On the other hand, if you want exposure to real estate but don't want to be a landlord, you could look into REITs or real estate investment trusts. They work kind of like a mutual fund, but they own portfolios of real estate instead. So like I said from the start, Milestone 6 is an exciting place to be because you really begin to get flexibility with your money that you didn't have in Milestones 1 through 5. It may not be total financial independence yet, but if you've come this far, it's much easier to see a clear path to the finish line. It's only a matter of time now. Now, next up, we'll be talking about Milestone 7, which is pre-funding your kids' education expenses. As always, I am grateful for your time and your interest in my videos. God bless and take care.